The stock market might seem overwhelming at first. Charts, tickers, bulls, bears, what does it all mean? If you're just getting started, this video is for you. Welcome to the Beginner's Guide to Understanding the Stock Market. We'll break it down in plain English, what the stock market is, how it works, and why it matters for your financial future. Today, we will talk about the Beginner's Guide to Understanding the Stock Market. So before we get started, make sure to hit that like button, also subscribe to my channel. 1. What exactly is the stock market? The stock market is like a giant marketplace where people buy and sell shares of companies. When a company decides to go public, it offers pieces of itself to investors in the form of stocks. Buying a stock means you own a small part of that company. The stock market is made up of different exchanges, such as the New York Stock Exchange and NASDAQ, where these trades happen. These exchanges provide a transparent place for buyers and sellers to meet and agree on prices. Stocks allow companies to raise money to grow, while investors hope the company's value will increase over time so they can make a profit. 2. Why do companies sell stocks? Companies need money to do many things: build new products, open new locations, hire staff, or pay off debts. Instead of borrowing money and taking loans, companies can sell stocks to raise funds. When you buy stock, you become a part owner of that company. This means you share in its successes and risks. If the company grows and makes profits, the value of your shares can increase. On the other hand, if the company does poorly, the stock price can drop and you could lose money. Selling stocks allows companies to get the money they need while giving investors a chance to share in their growth. 3. How do stock prices change? Stock prices don't stay the same. They move up and down constantly. This happens because of supply and demand. If many investors want to buy a stock, its price goes up. If more want to sell, the price goes down. Several things affect supply and demand. Company news, like strong earnings or new products, can make a stock more attractive. Economic factors, such as interest rates or unemployment numbers, also influence stock prices. Global events, like political changes or natural disasters, can cause stock prices to jump or fall. Understanding why stock prices move helps you make better investment decisions and prepare for market ups and downs. 4. Types of stocks you should know. There are different types of stocks, each with its own features and risks. Common stock is the most widely known. Owners of common stock usually have voting rights in the company and can earn dividends, a share of the company's profits. Preferred stockholders usually don't have voting rights, but have a higher claim on assets and dividends, meaning they get paid before common shareholders if the company faces trouble. Some stocks are also classified as growth stocks, which focus on companies expected to grow quickly, but may not pay dividends. Others are value stocks, which belong to established companies often paying steady dividends. Knowing the different types helps you choose investments that match your goals. 5. What role do stock exchanges play? Stock exchanges are the official places where stocks are bought and sold. The two biggest in the U.S. are the New York Stock Exchange, NYSE, and NASDAQ. Exchanges make trading easier and safer by setting rules and ensuring all transactions are transparent. When you want to buy or sell a stock, you do it through a broker who sends your order to an exchange. The exchange matches buyers with sellers to complete the trade. Exchanges also provide price information, so everyone knows what the current value of the stock is. Thanks to exchanges, stock trading happens smoothly and fairly. 6. How to start buying stocks. To buy stocks, you need to open a brokerage account. Brokers act as middlemen, connecting you with the stock exchanges. Nowadays, many online brokers offer simple accounts with low or no fees, making investing more accessible. After you open an account and deposit money, you can research and buy stocks. It's important to start by learning about the companies you're interested in. Look at their business model, financial health, and growth potential. Investing isn't about quick money. It's about choosing solid companies to hold for the long term. Start with small amounts you can afford to keep invested for years. 7. Understanding the risks of stock investing. Investing in stocks carries risks. Prices can fall, sometimes sharply, and you can lose money. The stock market can be unpredictable, reacting quickly to news or changes in the economy. This volatility is normal, but it means you need to be ready for ups and downs. One way to lower risk is diversification, spreading your money across different stocks or other types of investments. This way, if one stock does poorly, others might do well and balance your portfolio. Remember, investing is not gambling. It's about making informed decisions and thinking long-term. 8. What are dividends and why do they matter? Some companies share their profits by paying dividends to shareholders. Dividends are usually paid regularly, quarterly, or annually. They provide investors with a steady income in addition to any profit from selling the stock at a higher price. Dividend-paying stocks are popular among investors who want regular cash flow or who plan to hold stocks for a long time. However, not all companies pay dividends. Many young or fast-growing companies prefer to reinvest profits back into the business. Dividends are an important factor to consider depending on your investment goals. 9. Long-term versus short-term investing. There are different approaches to investing in stocks. Long-term investing means buying stocks and holding them for many years. This strategy takes advantage of the stock market's tendency to grow over time despite short-term ups and downs. Patience and discipline are key here. On the other hand, short-term investing involves buying and selling stocks quickly, sometimes within days or weeks, to try and profit from price changes. This can be risky and requires careful timing and knowledge. For beginners, long-term investing is usually safer and more rewarding. 10. Keep learning and start small. The stock market can seem overwhelming at first, but the best way to learn is by starting small. You don't need a lot of money to begin. Many brokers allow you to buy fractional shares, so you can own part of a stock even if the full price is too high. Take time to educate yourself. Read books, watch videos, and follow trusted financial news sources. The more you learn, the better your decisions will be. Remember, investing is a journey, not a sprint. Start with small, smart steps and build your confidence and portfolio over time. The stock market is not just for experts or the wealthy. Anyone can start investing with the right knowledge and patience. By understanding what the stock market is, how it works, and how to manage risks, you put yourself in a strong position to grow your wealth and achieve your financial goals. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.